Germany is in great trouble. For decades it has been known for precision engineering, export prowess, fiscal discipline, and safe haven bonds that anchor European finance. That reputation helped make Germany the backbone of the euro, the steady counterweight whenever markets shook. Now the machine is sputtering. Germany is entering its third straight year of recession, and more than 3 million people are out of work. Rather than watch a slow decline, Berlin is reaching for a dramatic rescue, a €500 billion program to jolt the economy back to life. The unavoidable question is whether saving Germany in this way puts the euro at risk, because the guarantor that wrote the rules is now prepared to bend them. So in Germany, things once looked perfect. Small and medium-sized companies, called the Mittelstand, made the special parts and tools that big names like Volkswagen, BMW, Mercedes-Benz, Siemens and BASF needed. While many other countries moved towards service jobs, Germany kept building and selling cars, machines and chemicals all over the world. Exports made up almost half of the country's economy, bringing in money and keeping borrowing costs low. It seemed like a system that could never fail, but it did. Germany's success depended on cheap energy, strong Chinese demand, and easy global trade. After 2020, all of that started falling apart. COVID-19 shut down factories and blocked supply chains. Then Russia's invasion of Ukraine stopped the flow of cheap gas that powered German industries. At the same time, China's economy slowed, and its car and battery companies began beating Germany's automakers in the global market. By 2024, the damage was clear. The economy had lost about $200 billion. Factory production hit its lowest level in 15 years, and car exports dropped fast. Many companies started moving to the United States and East Asia, where energy was cheaper and governments offered more help. What was once Germany's biggest strength, its exports, had become its biggest weakness. In Germany, there is a rule called the debt brake that limits how much the government can borrow. It was added to the German constitution after the global financial crisis to prevent too much debt. This rule says the federal government can only have a small budget deficit, about 0.35% of GDP, and can borrow more only in real emergencies. German courts have been very strict about this, even blocking parts of climate and industry funds when they thought the government was bending the rules. In good times, the debt brake helped Germany look financially responsible and kept borrowing costs low. But during long economic slowdowns, it became a problem. Other countries could spend more to support their economies, while Germany was stuck with tight limits. As unemployment rose above 3 million and factories faced high energy prices, this strict rule, once a sign of discipline, made it harder for Germany to take action and worsened its economic troubles. Germany was suddenly under pressure from all sides. Factories were slowing down, electricity was expensive, and global tensions were rising. Then the United States, one of Germany's biggest markets, added new tariffs on cars, steel, aluminum, and high-tech goods. For German companies that depend on exports, even small tariffs hurt. Car makers were already spending huge amounts to switch from fuel engines to electric ones, and now their profits were shrinking even more. At the same time, Europe's security problems were getting worse. Because of Russia's war and rising threats, Germany had to spend much more on defense, buying tanks, missiles, and rebuilding its army to meet NATO's target of 2% of GDP. But Germany couldn't easily spend that money. Its debt brake rule limits how much the government can borrow. So, while it tried to help struggling industries and pay for defense, the budget started to crack under pressure. The outside world was saying, do more, trade harder, defend stronger. At home, the message was desperate. We need help now. By 2025, Germany hit a breaking point. The economy was shrinking, energy prices were jumping up and down, exports were hit by new US tariffs, and defense costs were rising fast. Something had to change. Berlin faced a tough choice. Keep the strict debt brake rule and watch factories close, or bend the rule and try to save its economy. Germany chose to bend. The government launched a massive €500 billion plan, the biggest peacetime investment in its history. The money would go toward cheaper energy, stronger factories, better defense, and fixing the country's roads, trains, and digital networks. For a country that always preached no debt, this was shocking. Supporters said it was about survival. Critics warned it could shake the euro itself. But everyone agreed on one thing: what Germany does next will decide its future. The new plan isn't just about throwing money around, it's a full strategy with many parts working together. One part focuses on energy, giving factories short-term relief on power prices, offering long-term energy contracts, speeding up power grid expansion, adding more storage, and building a national hydrogen network to make heavy industries like steel, cement, and chemicals cleaner. Another part focuses on high-tech manufacturing, attracting chip makers, battery plants, and precision suppliers with big incentives. So advanced research and production stay in Germany instead of moving to countries with bigger subsidies. A third part deals with defense and technology, long-term orders for air defense, munitions, cybersecurity, and secure communications, all meant to rebuild industrial strength and spark innovations that can also help civilian industries. A fourth part improves infrastructure, faster rail lines, bigger ports, and better digital networks to cut costs and move goods more easily. Finally, there's tax relief and simpler rules to encourage private companies to invest, while cutting through the red tape that has slowed down projects like wind farms and new factories. The idea is simple: cheaper, cleaner power lowers costs, faster transport raises productivity, more chips and batteries secure future exports, defense spending keeps supply chains alive, and easier rules speed up investment. If Germany can roll this out quickly and effectively, growth could return, unemployment could drop below 3 million, and confidence, both at home and abroad, could finally come back. Here's the part the rest of Europe worries about. Bonds are the benchmark for the Eurozone. Every treasury prices off them. When Berlin issues hundreds of billions to fund this plan, Bund yields can rise simply because there's more supply. And when German yields rise, spreads for more indebted countries often widen because investors demand extra compensation relative to Germany. So Berlin's rescue can raise borrowing costs across Europe exactly when other governments also need to finance their own energy transitions and industrial upgrades. That means difficult budgets in Italy, Spain, Greece, and even France, fewer domestic projects, or tougher politics to pay for them. Saving Germany might, at least for a while, make it harder for others to save themselves. There's a reputational layer too. The euro's credibility has long rested on the idea that Germany would never spend recklessly, that it would enforce rules, not blur them. If the guarantor bends, markets start asking who's next. That doesn't mean a crisis tomorrow. It does mean the risk of slow erosion if projects slip and debt ratios drift. Caught in the middle is the European Central Bank. If the ECB loosens to keep spreads contained and growth alive, the euro weakens and inflation risks grow. If it stays tight, weak economies and parts of German industry struggle more. In earlier crises, from the euro debt crash to the pandemic, investors kept lending to weaker European countries like Italy and Greece, not only because they trusted them, but because they believed Germany would never let the system collapse. Berlin's strength acted as a safety net, keeping borrowing costs low and giving everyone time to recover. Now things are changing. Germany's massive 500 billion euro plan will draw in a lot of investment for itself. That means higher German bond yields, and in turn, borrowing will become more expensive for other countries. Big national projects across Europe, such as ports, power grids, batteries, and defense, could suddenly face tighter budgets. Unless the European Union creates stronger shared financial tools and Germany's investments quickly boost productivity, the whole region could start to feel pressure just when it needs more breathing room. The ripple effects could be even larger. If Germany's public spending attracts investors to put money into German bonds or companies, less money will be left for countries like Italy and France. That would make it harder and more costly for them to borrow. Some might have to shorten repayment timelines or offer higher interest rates, both risky moves in uncertain times. At the same time, if Germany's plan quickly makes its industries stronger, power cheaper, and innovation faster, its companies could start gaining a bigger share of the European market. Neighbours who cannot invest at the same level might struggle to keep up. That is the paradox. A recovery that helps Germany could unintentionally weaken others. The only real fix is smart shared policy, joint financing, faster approvals, and coordinated infrastructure planning so that progress lifts all of Europe, not just Germany. So the best case scenario here is permits clear, shovels hit dirt, renewables, storage, and hydrogen scale on time, Power prices fall toward competitive levels, rail and ports unclog, semiconductor and battery complexes anchor supply chains, defense orders stabilize suppliers, and growth flips positive. Bund yields settle, spreads narrow, and Germany proves it can marry discipline with strategic investment. The euro comes out stronger, not weaker. Worst case, permitting fights and court rulings slow builds, costs overrun, global demand stays soft, tariffs intensify, Chinese competition accelerates, energy remains volatile, banks tighten credit, Bund yields grind higher, spreads widen, ratings pressure mounts, and the ECB faces a lose-lose. Loosen and risk a weaker euro, or stay tight and deepen recession. Confidence doesn't snap, it thins one missed milestone at a time. Germany built the euro's backbone with discipline. Now it's betting big to save itself. This 500 billion euro push isn't just stimulus. It's a stress test of whether a rules-based currency can bend without breaking. The next chapter won't be written in speeches, but in metrics. If those needles move, Germany rebuilds its engine and the euro's core strengthens. If they don't, credibility will erode one missed milestone at a time. Want the scorecard, not the spin? Subscribe and turn on alerts and drop your questions below. What metrics should we add? And if this helped you see the stakes more clearly, share it with someone who still thinks Europe's crisis is tomorrow's problem. The timeline is now.